In this video, we will take a look at Rivian Automotive, a name that has been heard across the investment landscape over the past few years. We will dive deep into the company, riding the wave of unusual options activity, look at the technical terrain, and look at the latest news of the company. We will also explore the multitude of factors shaping its path ahead. Before we begin, if you like my content, please consider to like, comment, and subscribe. Recently, there was a bit of a bizarre phenomenon going on for Rivian, as unusual options linked to Rivian surfaced on August 24. At the heart of this phenomenon lies the September 1, 21 strike puts, a focal point where volume and open interest harmonize at 19,000. This convergence hints at a calculated strategy, potentially involving profit-taking and a reshuffle. Transitioning our gaze to the September 15 options, the 18 strike puts emerge as prominent players, boasting significant volume and an eye-catching open interest volume of 16,262 contracts. This orchestrated interplay between options implies a larger narrative in motion, probably suggesting that the market sentiment believes that a pullback is to be expected while trading the stock. There is also a correlation that came to light. All these intricate transactions occurred in a precise alignment of time, down to the very second. This temporal unity not only underscores the connectedness of these trades but also suggests a meticulously orchestrated dance of strategy. Realistically, I believe that the options are traded in by one institutional order, in the anticipation of profit-taking, or a pullback from the previous month's order. The canvas of options paints a bearish landscape for Rivian's stock trajectory. The 18 strike puts reveal a negative delta, outlining the bearish stance taken by investors. Positioned beneath the present stock price, the break-even point serves as a reminder of the bearish undertone that is currently in the market. For profitability, Rivian's stock must descend below $17 by the approaching September 15 or, ideally, witness a notable dip beforehand. The electric vehicle industry underwent a transformative period, marked by the bursting of the electric vehicle bubble. In this context, this article explores the potential consequences of geopolitical uncertainties, supply chain shortages, rising inflation, and interest rate fluctuations on the stock price of an electric vehicle manufacturer like Rivian over a 3-year horizon. Geopolitical uncertainties wield substantial influence over stock prices. Trade tensions, political conflicts, and regulatory changes can disrupt supply chains, hinder market access, and erode investor confidence. With countries re-evaluating global trade dynamics, electric vehicle manufacturers like Rivian might confront challenges in sourcing materials, production, and distribution, leading to potential delays and increased costs. These uncertainties could cause investors to adopt a cautious stance, negatively impacting Rivian's stock price. Supply chain shortages disrupt various industries, affecting companies' ability to meet demand and generate revenue. Rivian, as an electric vehicle manufacturer, relies on a complex web of global suppliers. Shortages in critical components such as batteries, semiconductors, and rare earth minerals could limit production capacities, delay deliveries, and raise costs. Investors might respond with concern, potentially leading to decreased stock prices due to lowered growth expectations. Inflation erodes purchasing power and significantly impacts businesses' profitability. As the cost of raw materials, labor, and inputs rises, companies may struggle to maintain profit margins. For Rivian, increased production costs could squeeze profitability, prompting investors to reassess the company's financial outlook. This could result in reduced stock prices as investors weigh the potential impact of inflation on future earnings. Rising interest rates affect stock prices through multiple channels. Higher borrowing costs can hinder companies' ability to invest and expand, potentially slowing growth prospects. As interest rates rise, fixed income investments become more attractive relative to stocks, causing some investors to shift their portfolios away from equities. In sectors like electric vehicles, where expectations are often factored into stock valuations, any reduction in investor demand can lead to downward pressure on stock prices, including Rivian's. Over 3 years, the cumulative impact of these factors could be significant. While Rivian's innovative products and strategic initiatives might help mitigate these challenges, uncertainties related to geopolitical events, supply chain dynamics, inflation, and interest rates could still influence investor sentiment. The post-electric vehicle bubble landscape requires a careful balance between growth expectations and external pressures reality. The aftermath of the electric vehicle bubble has created a complex environment for companies like Rivian. Geopolitical uncertainties, supply chain shortages, rising inflation, and interest rate fluctuations all hold the potential to impact the company's stock price over a 3-year horizon. Navigating these challenges necessitates adaptive strategies, resilient supply chains, and effective communication with investors to maintain confidence in the company's long-term prospects. As the industry evolves, the interplay between these factors and investor sentiment will play a pivotal role in determining Rivian's trajectory in the post-electric vehicle bubble era. Overall, I believe that Rivian is a company that has a lot of potentials in the electric vehicle market, and that given time it can definitely grow larger from where it stands now. With that being said, the recent price action has been heavily suggesting for a round of pullback, and I believe that the timing may be better chosen if we choose to enter at a later date.